Hi, everybody. Welcome to the 7 and 7 show with Zack Ellison. Today, I have with me Richard Hillson, a good friend and an expert in alternative investments. Richard is the founder and CEO of Hillson Consulting. And Richard, love to hear about your background and fill everybody in.
Sure. Thanks for having me, Zack. We've done quite a few presentations now, and I always enjoy kind of our vibing back and forth. So good to be working with you again. So, I mean, my background in a nutshell, I went to law school in the UK, worked for Barclays at the beginning of my career, and then went into investment banking. I set up a private equity firm in Manhattan back in 2011. I think, yeah, 2011, that sounds right. And that kind of morphed into an alternative investment boutique investment bank broker-dealer. We also ran an RIA aggregator for a few years. So I've been CEO of a broker-dealer and an RIA for my sins, let's say, in a past life. So a couple of years ago, I saw an opportunity in the marketplace based on my biggest frustration, which was speaking to brokers, investors, RIAs, but predominantly RIAs, is the dreaded A word, alternatives, is sometimes you'd say alt and you'd literally get this visceral reaction where someone's whole body tenses up, like you drop the F-bomb in conversation. It was just, why is alternatives a dirty word? And even moderately sophisticated investors and RIAs who were running a few $100 million worth of assets was still terrified of alternatives or just didn't understand it. And I was legitimately sick of having the same conversation where, oh, I don't do alternatives. That's much too high octane for me. That's Bobby Axelrod from Billions, or that's crypto. No, it's not. That can be conservative real estate yield with a investment grade tenant, which is actually less volatile than most equity plays. But it was frustrating me, this lack of understanding in the space, and the fact that this broad terminology of alternatives includes so many different things that it does the whole industry a disservice, because more conservative alt shouldn't be lumped together with crypto. It just doesn't make sense. So I thought, how do I change that one investor, one advisor at a time? And I essentially believe that alternatives are misunderstood, underrepresented, and need to form a part of every portfolio. How do we change that? So I work with investors, I work with RIAs, I work with brokers to help them navigate and grow their alternative investment part of their business. And I work with quality sponsors, quality products such as you guys, to help you educate and get traction in the fragmented RIA space. So yeah, that's what I do. Anything that furthers the cause of alternatives and makes them easier to understand and easier to navigate, basically.
I think you've done a great job with it in the sense that you're one of the leaders in educating folks in the RIA space. And, you know, it's not easy. Like you said, why do you think alternatives had that bad connotation in the past?
Yeah, so it's a combination of factors, and we could do a whole session on this, and we won't. There's too many other things to cover, but essentially it's this catch-all terminology, which is a problem. And the other thing is that, and I'm not accusing anyone of being lazy or anything here, but comfort zones are just a fact of human nature. And the equity markets were so kind for 10 years plus. Even if an RIA, an investor, agreed with the principle, yeah, we need to diversify into different types of less correlated asset classes in the alt space, it's damn hard to do that when the equity market's doing 20%. Almost each year, at least 15% until, let's call it, the last year or so, when we've actually had the downturn. And so what is the need to get outside of your comfort zone at that point? The 60-40 model was still delivering to some degree. The yield side was poor until the last 12, 18 months or so. But when your equities are performing, there's no reason to get outside your comfort zone. So it's only the last 18 months or so that we've seen some of these staunch 60-40 disciples actually start to broaden their horizons. So for me, it's a combination of the misunderstanding, the misconceptions, the broad terminology, but then also because you kind of didn't need to diversify that much because the equity markets performed for so long, is it makes it very easy to stay in your comfort zone. And I don't blame anyone for that. But guess what? Now they're actually starting to see the light and look elsewhere because they need to.
One of the things that's changed too is that there are a lot fewer public companies now than there were 20 years ago. And so if you want a truly diversified portfolio, you actually need to be in alts, and stocks and bonds will not cut it from a diversification perspective. And we saw in 2022, of course, the correlation between stocks and bonds was very high, and that both were down significantly. So folks that were in a 60-40 portfolio consisting of 60% stocks and 40% bonds had one of the worst years in the last 100 years. And I think it was the worst, if I'm not mistaken, or close to it. And so, yeah, I mean, what we're seeing now is just a big move into alts broadly. I think people don't even really understand like what alts means. And so just to define it for folks, alternative investments are anything that's not a public stock or bond generally. So what that means is that includes private credit, it includes real estate, it includes private equity, it includes venture capital, it includes hedge funds, infrastructure, basically anything that's not a public stock or bond. The list goes on. And if you think about some of those investment characteristics, they're very different depending on what type of alternative that you're in. Crypto has nothing in common with real estate, for instance. And private credit has a very different risks characteristics than venture capital, for instance. And so I think that's what people are starting to learn, is that within alternatives, there's a lot of different flavors, and there's a much more variety. If you're in stocks and bonds, it's kind of like going to an ice cream store, and there's like, we've got vanilla and we've got chocolate, and sometimes we have strawberry, but not always. And hopefully you like one of the three. And that's really kind of what it's like in the public markets. Whereas, in the alt space, it's like going to one of the ice cream stores it's got like 400 different flavors. Some of them you'd never touch, but some of them are amazing and you can't find them anywhere else. And so that's kind of how I think about alternatives and what it brings to the market. I wanted to ask you, what do you think are the benefits of alternatives broadly in terms of including them in your portfolio, especially for RIAs and wealth managers?
Yeah, and actually just to expand on one other point is, when in these conversations, when someone says, oh yeah, I don't touch alternatives, I had a bad experience with crypto or something, that's like saying, I once picked a bad stock, I'm never picking a stock again. It's just nonsensical. So just be, okay, stay the hell away from crypto then if you've had a bad experience with crypto, but don't let that color your decisions in the rest of the alt space. And that is still part of the issue here. And so your question was kind of the allocations to alts. So there's a lot of different kind of methodologies and ideas about. The most basic would be 80% of the portfolio would go into 60-40 and 20% would go into alternatives. And then you pick some different things within the alts world, maybe some real estate, commodities, private credit, a couple of tax planning angles. And for me, it's more a case of have a look what the basis of the alternative investment is. Is it a yield-based, conservative yield-based play, or is it a total return potential? It's a total return type play that comes out the equity 60. If it's a conservative yield play, that comes out of the 40 side of things. So it's about the subcategorization, which is really important, because again, another thing which always frustrated me was this typical assumption, oh, alts are all out of the risk pot. So the 10% risk capital, which is part of the 60, that's your alts allocation. No, it's not. It depends what type of alts it is. If it is crypto, then that's your risk bucket. If it's conservative real estate play, which is yield based with an Amazon distribution facility, so investment grade tenant, that's your conservative 40. So, but the key thing for me is actually having diversification within diversification. Whatever your allocation to alts, then you do want a number of different verticals within the alt space, whether that's real estate or commodities or private. private credit, private debt is the fastest growing area in the alt space at the moment. And we'll talk in a bit about that being a real trend at the moment, if people starting to open up within the alt space. But for me, there needs to be diversification within diversification. Once you know what your alts allocation is and what's your yield side, what is your total return side, then there's diversification within that into the different types of alternatives available, the different verticals.
I think that's a great way to think about it, in the sense that it's kind of like bucketing in really broad terms, like you said, total return or growth, and then lower, maybe perhaps lower growth, but steadier return and income. And if you find like a private credit strategy or a real estate strategy, for instance, that would actually go into that 40% income bucket. And if there's something that's got a total return play, or there's more growth oriented, that would go into the 60% bucket. And ultimately, it's the diversification that really adds to the portfolio optimization. And I think a lot of people overlook that. People tend to be, non-professionals at least, tend to be very focused on deals or specific trades or specific stocks or bonds, but they're not really thinking holistically about their portfolio. And if you talk to a professional, a portfolio manager, for instance, they're really thinking about the portfolio construction first and making sure that the diversification is there, because that's ultimately going to produce better risk-adjusted returns. And I think that's what people tend to overlook, because they're chasing specific transactions rather than thinking about portfolio optimization. So in terms of the RIA space in particular, what are some of the other trends that you're seeing now in terms of what folks are doing?
Yeah, so the trend of the last couple of years is those diehard 60-40 guys finally getting the message, because they had to, because everyone knows that 60-40 going forward is a broken model. But again, as we touched on earlier, is the comfort zone of equities performing really well makes it hard to get out of positions that are still performing well. And so last couple of years have been a lot more old school advisors and investors starting to look more into alts. And I affectionately call the basic real estate, or REITs, as kind of like a gateway drug into alts. Is start with something simple, and the guys who dip their toe in the water by doing maybe a basic multifamily kind of REIT are now saying, what else is there? Because equity in certain types of real estate is not performing. So those who still want to stay within the real estate classification are now saying, okay, what else is there? So we're looking at debt in real estate rather than the equity, which was the starting point, or looking at some slightly different real estate asset classes, such as self-storage or digital infrastructure. I worked with a company recently that does cell towers and data centers. So it's real estate, but with a kind of a tech potential extra upside to it. Or advisors are getting a bit braver now and saying, okay, what else other than, let's say, real estate and oil and gas is there? And that's one of the reasons why private credit, private debt is one of the fastest growing areas of the market, because typically it's actually a yield play. And certainly the last couple, we've seen a bounce back to some degree, but given inflation where it is, people are actually chasing these higher yields because they need to. And so in just about every presentation I've sat in on recently, everyone's talking about the fastest growing asset class being private credit, private debt. So it's reassuring for me to see, first of all, that old-fashioned portfolio guys starting to embrace alternatives, or at least dip their toe in the water. And now guys who just dip their toe in the water asking what else is out there, which is good for the industry. And a lot of that is because of the education and the effort so many different groups are putting into to make it easier to custody, report, bill, diligence, all of these things, which make it easier for someone to inch outside their comfort zone. Because previously, all right, I'm going to do alternatives. Their custodian doesn't hold it. Back to my comfort zone. The first excuse to get back there. But the industry is changing and making it a lot easier for the mass affluent high net worth, without it just being ultra high net worth and family offices, which used to be the traditional kind of alternative investment investors.
I agree with you in that private credit and real estate are both great entry points because they tend to be lower risk and a little bit easier to understand. I mean, certainly most people understand real estate intuitively because they often own a home or they've been involved in some commercial real estate at some point. So it's pretty straightforward. They understand there's a physical asset, it generates some cash flow, and then they get a portion of that cash flow. Private credit is really no different. Really, it's just loans, oftentimes to corporations that just tend to be smaller and non-public than what you'd see, in the public markets, in the bond market, for instance. So it's really nice as well because most of these loans in private credit are floating rate, and so all the interest rate hikes have not only not hurt investors in private credit, it's actually helped them because now their interest rate yield has gone up over 500 basis points in the last 18 months. And that's something I like to remind people that when you're buying bonds, these are almost always fixed rate securities, meaning they have interest rate risk. As rates go up, the price of that bond goes down. And that's what we saw in 2022 when credit spreads performed fine, but rates went up, and that devastated the returns on treasuries and mortgage-backed securities and fixed rate corporate bonds. And so that's what's really nice about private credit is you get corporate credit exposure, but you don't have that fixed rate. And also certain types of private credit have equity participation, as usually through equity warrants. And that could be in mezzanine credit, for instance, or it could be in venture debt, my firm strategy. And that's a nice little kicker because you're getting that steady income and you're usually pretty senior in the capital structure, meaning you're going to get paid before the equity holders if things go wrong. But then you also have a lot of participation on the upside, which is nice. So you're not necessarily giving up growth when you're in certain private credit strategies, which I think is makes it very appealing from multiple perspectives, right? Because people want safety, but they also want to participate in the upside, and you don't really see that in corporate bonds.
And is that the perfect segue to actually start talking about your guys' strategy in terms of, that I'm a fan and I've been an advocate of venture debt, and to you guys, let's swap roles for a moment here. And if I guess when we've done our presentations, I've put on the hat of on behalf of the advisors to say, here's some of the questions that I would ask and that I get asked about. So I guess let's start with the basics. Is what is venture debt? And tied into that is, I know we spoke earlier about people's whole body reaction when you say the alt word, but we have a kind of similar thing here when with venture in the name, it scares some people, and I don't believe that's justifiable, but people assume a certain risk profile based on it just having venture in the name. So let's address that as actually point number one, talk about what this means and why having venture in the title isn't a reason for everyone here to go running for the hills the second we say that.
It's a great point. I think you're right. And if we could rename venture debt something else, I think that would be great for folks in the space in terms of just the ability to make this visible from a fundraising perspective and less scary. But the reality is the word venture in venture debt actually means it's less risky, because what venture debt is it's a loans to venture-backed companies, right? So it's basically short duration, typically 2 to 4 year loans that are floating rate to the best venture-backed companies in the world. So these companies are essentially have the ability to raise a ton of equity capital, but the founders don't want to sell more stock in their company than they need to. And that's pretty intuitive. If you have a company that's doing well, why would you want to sell ownership now if you think it's going to be worth a lot more later? So founders are very keen to use venture debt because they can raise some equity capital and then complement that by borrowing some money at a much cheaper cost of capital, and also much less dilutive capital. Because ultimately, these loans do come with equity participation, but it's substantially less than a straight equity raise. So think of a standard loan might be a 3 to 4 year loan, mid-teens, all-in cash yield, we call it 15, 16% yield, and then another 50 to 100 basis points of equity in the company as well. So the total returns are somewhere in the low 20% range, sometimes higher. And there's very low volatility in those returns because the majority of returns are coming from the credit component, which is contractual. The interest is coming in every month, in fact, for these loans as opposed to quarterly, and they're floating rate, so you don't have any interest rate risk. So you've got that like steady return, and then you've got the upside skew with some of the companies that eventually get bought and go public. You could have big time returns on single positions.
And the first question I asked you when we first started talking is about how this fits with the equity component. Is this seen as adversarial, if that's even, is this seen as competing with them? How do they feel about the fact that the debt goes at the top of at the top of the cap table? Essentially, is you sit above the equity side here. I can't imagine, or at least when we first started talking, I couldn't imagine how the venture guys actually like that, someone sitting above them as far as that's concerned.
Yeah, and it's a great question. Ultimately, most venture equity investors work hand in hand with the venture lenders. And in fact, venture lenders get most of their deals directly from the VC firms, who call them and say, hey, I've got portfolio companies that could utilize debt. They've reached that stage where they're generating revenue and they'd like an additional round of growth capital, essentially, to extend runway and help them grow the business, whether that's their marketing efforts, their software or tech stack. Maybe it's opening a new office in a different location. So think of venture debt as growth capital, and it comes after the equity raise. So one of the common misconceptions about venture debt is that it's for companies that need capital, and that if you can't get an equity raise done, then you should go try to get a loan. And that's just not the case. What happens in reality is that venture lenders are funding the top, call it 10 to 15% of venture-backed companies. And these are companies that will do an equity raise, but then they'll do maybe 15 to 20% of that round in debt to save themselves some dilution and also to reduce their weighted average cost of capital. So I'll give you an example just to put it in numerical terms. I think it helps people understand. Say there's a company that wants to do a Series C financing round, and they want to raise $50 million, 50. They might go out and do 40 in equity. And then after that equity round has been closed, they'll tack on 10 million in debt. So they get their $50 million, but the founders have saved themselves 10 million in dilution, essentially. Now, the equity VCs, to your question, are appreciative because ultimately this capital is helping to de-risk their investment as well. Because what they want to see is the company be successful and reach an exit, just like the lender does. And so they're not really combative. They're much more collaborative in the sense that everybody is aligned and they all want this company to do well over the longer term, have a successful exit. And that doesn't mean they need to IPO. It means they could, get bought. It means they could become, a steady run rate company that never does another round. Or they might just do another big equity raise later at a much higher valuation, which benefits all the existing shareholders as well as the lender. And so think of VCs and venture lenders as partners. And ultimately, even when things go bad, from what I've seen, looking at over 5,000 historical deals dating back to about 20 years ago, there's very few situations where it wasn't worked out amicably, in the sense that everybody's incentivized to help the company as much as they can and extract as much value as they can, and not to necessarily be fighting over it. And so there's a lot of teamwork that goes into it, and ultimately it's the relationships between the VCs and the portfolio companies and the lenders. Think of it as like a triangle, like almost like a three legs of a stool. There's relationships between all three, and it's those strong relationships over time that ultimately lead to very successful outcomes.
And so, I mean, we've looked at plenty of data in some of our previous presentations in terms of the default, the risk, and things like that. But I guess the first thing when we first ironed out, in my mind, this not competing with the equity side, but it being complementary. The next thing that went through my mind is, well, if you've done the 10 mil on top of 40 mil from some of the smartest guys in the room, they're not going to let this default and you basically, the debt, which has priority here, get everything, is that's feels like another reason why it's de-risked, because you're in sitting above these guys, they are not going to let this default, and essentially the debt holders would then own all of the IP and the assets. Is that a simplification, or is that actually one of the reasons why we do see these remarkably low default rates?
I think that's a big part of it. I mean, it all starts with underwriting a quality company, right? A company that's got traction, that's got a revenue base, that's growing, that's got a strong management team. And a good lender will first underwrite the operating company. Is this a good company in terms of its credit fundamentals? And then in addition to that, it just so happens that they have this strong equity sponsorship group that you would not see with a non-VC backed company. So it's almost like an extra layer of risk protection, but it's not what you're ultimately relying on. But it does help quite a bit if you're funding companies that are tech focused. So they're growing very quickly, typically. They've got huge scalability. And they've gone through an equity raise recently, which means they've gone through diligence. And there's been smart VCs who have put their money where their mouth is. It's not just the company saying, hey, we've got a good model. They've gone out and convinced top VCs to give them 20, 30, 40, $50 million before we even come in as a lender. And then, of course, the lender is going to do their own deep due diligence and underwriting process. And so I think it starts with a quality company, and then sizing the deal correctly makes a lot of difference. You want to make sure that companies are not over levered. Just like any company, some debt is good, too much debt is bad. That's true for any company. And so the way that we think about it is you keep the loan to value in the 10 to 15% range, meaning figure out what's a fair valuation for this company, not what's a hyped up valuation at peak market, a real conservative, realistic valuation, and then lend no more than 10 to 15% against that. That means the company could lose 85 to 90% of its value, and you're still unimpaired as the lender. Right? So if you think about it in steps, the first step is find a company that's a strong operating company. It's got revenue, it's growing quickly, it's got great prospects. Then you take that company and you provide it with some debt, but you size that debt appropriately versus the enterprise value and versus the revenue that they're generating, and also versus the cash they have and the strength of their balance sheet. So you've already kind of checked a couple boxes, and then you're going to look at what is the collateral and what is the recovery value if things go wrong. If everything in the world goes wrong for this company, will I still be able to come out whole as the lender? And the reality is that most venture loans actually have recovery rates, if they do default, north of 90%. And you're going to say, that sounds crazy. How could that be? I'm going to walk you through a quick example, and you'll see mathematically why it works out. And it's very easy to prove, even to non-believers. So say we make a 3-year loan to a company. Typically, these loans are structured so that the first year or so is interest only. So say I make a loan to you, Richard, you're paying me 15% interest that first year, but you're not paying down any principal on the loan, okay? Then in year 2, the loan starts to amortize, meaning you're in month 13, you're going to start paying back principal along with interest. In a 3-year loan that starts amortizing after year 1, if it's straight line amortization, that means you're going to make 24 payments over 2 years, paying back the principal on that loan. So say I've made you a $10 million loan. First year, you're paying me $1.5 million in interest, 15%, right? We get to year 2, the loan has amortized. So you've had 1 year of amortization, meaning you've paid off half the principal now as well in year 2. And you've paid me another year of interest. So if you do the math, I got 15% in year 1 for interest, 15% in year 2. and you've paid off 50% of the principal by the time we get to year 2 or the end of year 2. So I've got 80 cents back on every dollar I invested in your company in 2 years. So if you went belly up on that day, I'd still have 80% recovery. And in terms of dollar for, in terms of dollar in and what I'm bringing out. And so the reality is, this is why loans are so low risk, because you're making loans to companies that typically will have 2 or 2.5 years of runway, and you're making loans to companies that have great traction and they're growing. So it's not like they're going to go from hey, we grew 60% last year to all of a sudden we're out of business. Like, that just doesn't really happen. It's very rare. So you've got these companies that you're monitoring on a monthly basis as well, because you've got monthly interest payments coming in. You've typically got board observer rights also as a lender. So in real time what's going on with this company. And you've got covenants that protect you as a lender as well. Typically there's 2 covenants, at least on most deals. One will be what's called a performance to plan covenant, meaning the company has a certain revenue target in their plan. And if they miss that by a certain threshold, that will trip the covenant. And there's also typically a minimum liquidity covenant, meaning the company has to have a certain amount of cash on their balance sheet at all times. And so you've got all these protections built in, and the structure of the loans is such that you're de-risked immensely as the lender. So just to recap, you've got a very good operating company. You size the loan appropriately. You don't overlever the company. And then you structure the deal in a way that de-risks it as well, with covenants and there's other things you can do as well. Like there's what's called delayed draw features. So say you want to borrow $10 million, and I think 10 million is a little bit too much debt for you at this time. I could say, okay, we'll make you a $10 million commitment, but we're only going to release $5 million day one. And for you to unlock the remainder of that loan, you'll need to hit certain milestones, like grow your revenue by a certain percentage. So it basically ensures that your leverage is never too high. And so there's many, many things you can do as a lender in this space to keep the risk very low. And it's one of the big misconceptions. One of the biggest is that these loans have binary risk, because people think of venture lending and conflate it with venture equity, which is silly. It's kind of like conflating, like, how is a small cap stock going to fare relative to an investment grade bond? Like they're not at all related, right? Even the stock and a bond of the same company aren't related in terms of how they perform, right? And so I'm constantly having to explain to people, hey, look, this is actually, not only is it less risky than venture equity, it's actually less risky than corporate bonds, because you're also protected against interest rate increases. And the recovery rates on these loans are higher than you'd see in high yield, and higher than you'd see in the leveraged loan bank market, and higher than you'd see in some cases in the investment grade market, which is kind of crazy to think about, but it's true. So I think that kind of sums up why there's actually low risk in these investments. But it's hard to get people to listen. They hear venture and they're like, oh, I don't want to invest in venture. I'm like, you don't even know what we do, and you don't even know what venture debt is.
And so let's also address one of the other biggest. I think we're getting there in terms of getting the message out now, but certainly a few months ago, one of the biggest misconceptions is about Silicon Valley Bank. And at the time, I feel like the general public's view was that Silicon Valley Bank went under because it was making high risk venture loans, which is just completely not true. But that felt like the understanding of less sophisticated investors or whatever. And actually, it's completely different, and I think creates an opportunity in the industry. So while we're heading off some of these misconceptions, why don't we address that head on as well? As the elephant in the room, let's say, is what actually happened, and why is that not a reason now to be terrified of venture debt? It's actually, I think it makes it more compelling.
Yeah, so Silicon Valley Bank failed because they mismanaged their interest rate exposure. So essentially, they had a lot of deposit inflows and had to put that money to work. they couldn't put enough to work in the venture loan market. And so they wound up buying a lot of treasuries and mortgage-backed securities in 2021 in particular. Now, that was probably the worst time in history to do that because rates were still low. And Silicon Valley Bank had a ton of inflow. So they put a tremendous amount of money to work in these fixed income securities that didn't have much credit risk, but had a lot of interest rate risk because a lot of these were long duration and longer maturity fixed income securities. So when rates started to go up in 2022, those securities fell quite substantially in value. That led to Silicon Valley Bank having a lot of losses on their balance sheet. And they had taken off their interest rate hedges in 2022. And so it completely mismanaged the situation and were caught off guard. And ultimately, those losses are what led to what I'd call a loss of confidence in the bank, which kicked off a bank run. And given modern technology and social media and the speed of digital banking, they were basically out of business in less than 24 hours. So what's interesting that a lot of people, that saw this from afar didn't really realize what was going on, but now they can look back and it's crystal clear and there's no dispute. They blew themselves up because they didn't know how to manage their interest rate risk. Their venture loan book was actually the jewel in their crown and remains as such. And so that's ultimately why First Citizens Bank bought them, because they have this great ecosystem and connectivity with a lot of the startups and VCs, and that was what made them valuable. Everything else about the bank, in hindsight, was kind of like not valuable at all, quite frankly, right? And clearly they didn't know what they were doing at the top of the house. And I'm not afraid to say that. I mean, it's pretty clear. It's an embarrassment to the banking industry, quite frankly. But that said, I think it brought a lot of eyeballs to venture debt because they were the biggest lender in the space. Some said they were up to 50% market share, maybe even more. And so what this meant and what it means going forward is that you've had this big event that's basically shifted the supply and demand imbalance. So now there's an immense amount of demand for capital from startups, but the supply has been pulled back because SVB is no longer making as many loans, right? And a lot of the other regional banks as well have pulled back on lending for other reasons. I mean, look at what's going on with commercial real estate. That's the next shoe to drop. When we see third quarter and fourth quarter numbers, it's just going to blow a hole in a lot of regional bank balance sheets, and they're going to just have to pull back lending immensely. And that's also going to cause a loss of confidence on the part of depositors, which means you're going to see deposit outflows who are not only fleeing because they can get higher yields in treasuries, for instance, in T-bills, but they're also going to flee because a lot of these banks are going to have losses that are greater than their tangible equity value. So imagine you're a depositor in a bank and you see a headline in the Wall Street Journal that says, hey, your bank has losses greater than the equity value in the bank. And you're thinking, holy cow, I should pull my money out because most of the deposits at some of these banks are uninsured. And so I won't name all the banks now, but there's a long list of regional banks that are going to be in this boat, and it's going to be sinking. And so what this means is less capital is going to be provided by banks to startups and other corporates. And so there's this big gap in the market because on the demand side, we've had 3 years of record funding in venture equity. And so there's all these companies that got funded in 2020, 21, 22. And guess what? They're going to be coming back to market because the average funding cycle for startups is about 2.5, 3 years. So all the folks that got funded in 2021 are going to be looking for capital again in 2024 to keep the lights on and keep growing. Where are they going to get it? They're not getting it from the venture equity investors right now because the market's pretty much shut, right? It's hard to get an equity check these days. Capital is incredibly expensive. The check sizes are smaller. It takes a ton of time to get deals done. VCs got blown up the last couple of years. So they're sitting back saying, hey, we're taking a conservative approach. We're not really throwing money at everything like we were the last 3 years. So it's very, very hard for founders to raise equity capital, and it's very expensive for those that can. So that means they're going to look for debt capital to complement whatever equity capital they can raise. The problem there is that the debt capital is being pulled back too, because SVB and other regional banks are, pulling back. So now if you're a founder, you're in really dire straits in some cases. And it hasn't really hit everybody yet because they're flush with cash from what they raised in their rational bull market of 21 and to some extent the first part of 22. So you've got all these companies that are going to realize pretty soon, oh crap, our runway's running pretty short. We better get back to market. And guess what? They're going to be in a queue with thousands of other companies all thinking the same thing, right? And so what that means is, to sum this up, this is a supply and demand story, which is ultimately the first thing you should be thinking about as an investor. And I've mentioned this on the podcast before. Every single person I talk to will mention two things to you as being critically important. The first is diversification. We already hit on that. And the second is look for opportunities where there's greater demand than there is supply. It's Econ 101. It's what drives prices up, right? So if there's more demand for capital than there's supply, and I'm a supplier of capital, that means I've got great negotiating power, great leverage, and I can charge more for capital. And I can also be incredibly selective about the companies that I choose to lend to. I mean, the amount of deal flow we're seeing right now is just mind-boggling. I mean, we don't even have time to look at every deal because there's so many. I mean, it's kind of like, hey, you got to hit a really high bar just to have a phone call, just to have a Zoom meeting, because there's so many people in the queue. And that's not going to change. In fact, I think it's going to ramp up tremendously in 2024 because we've had a little bit of a reprieve this year. The markets have done okay. And I think the economy's held in a lot better than people anticipated, right? So it's kind of given people a little more runway than I think they anticipated if you think about where their forward-looking view was 12 months ago, right? But that's going to change at some point. The market is going to have a real recession. And at that point, imagine if you're trying to raise capital and not only do you have these supply and demand imbalances, but you also have a full-blown recession and public market valuations are getting smoked. I mean, how are you going to raise money? But if you're somebody who's got dry powder as a capital provider and you've got a clean balance sheet, you're going to have incredibly attractive vintage years in 2024, 25, and 26.
So in terms of, I guess, the summary of why this is a great opportunity at the moment is we lost the biggest player in the industry in SVB, but not because of this part of their business. So it's not a knock on that side of the business, but we lost the biggest player. The other lenders in this space, based on a number of reasons, are probably going to be laying out less capital and more conservative. The equity side of things is going to be more expensive or just not available because it's going to be tough to get to get equity in this space. And therefore, anyone who's got the capital to deploy can be even more selective and can actually charge more of a premium on the debt side of things. That feels like a pretty nice convergence of a number of factors, which make this really a really interesting time, if not hugely compelling time to look at this asset class.
I don't think I could design a better macro environment for a venture lender right now. Well, I should say though that if you're a venture lender with a clean balance sheet, I would not want to be a venture lender or any lender who was making a lot of loans at the market peak. I think they'll do fine, honestly. But that said, 2021 is going to be a terrible vintage year for almost every asset class. And loans are no different. I do think private credit will outperform most other asset classes. And I think venture debt will outperform most in private credit. That said, would I want a portfolio that I underwrote in 2021? Hell no. In simple terms, hell no.
But because these are short-term loans, you're not locked in like a real estate transaction where it might be a 5-year with some readjustment. But I mean, those legacy portfolios are scary.
And you nailed it. I think one of the reasons why venture debt will outperform in the 2020, 21, and 22 vintages is because the loans are short duration. And so by the time the economy really cracks, a lot of those loans will already be paid off, right? And so because like I said before, they de-risk pretty quickly because you're getting a high interest coupon and they're amortizing. So it's I think it's a great time to be a venture lender in general. But I think it's the best time to be somebody with a clean portfolio who can be very risk averse, knowing that things are going to get worse probably before they get better. And if you go in with that mindset, knowing, hey, we think the public markets are going to get smoked. We think real estate's going to get hit hard, especially commercial real estate. We think that inflation is still running rampant and has not been tamed, and we could be entering a stagflationary environment. If you go into it with that as your base case and you underwrite conservatively, knowing that that's probably what you're going to face, the likelihood of losses is very low. In other words, prepare for the worst, hope for the best. So with that, I want to turn it back to you. And I wanted to ask you a couple of questions. One is, in terms of lessons you've learned from watching others or your own endeavors, especially around risk and mistakes, and what are some of the takeaways you've had?
Yeah, so the industry is getting easier to diligence, and that was always the problem, is that a new sponsor came to market, and most RIAs don't have, the team or the bandwidth or the disposable capital to get a lawyer to do background checks on the management team for a new sponsor coming to market. And so there was always this risk, not just from I want 3 years of track record, is that you kind of think, I also want to see 3 years whether any skeletons come out of the closet kind of thing for new funds coming to market. So the industry's got better with third-party diligence firms who will do a report. And I think that helps diligence officers at RIAs, brokers, or whatever sleep better at night, because they have got a third-party report, which they've not paid someone bespoke to actually do it. They're just, the sponsor has paid for that. So I think that helps a lot. And it used to be really hard for newbies to crack the space, because you need capital to build a track record, but you don't get the capital until you get there. So I think that was always a risk, and there's been some bad actors in the space, but because alts is becoming more mainstream, yes, that means more people coming into it, which means the chances of, there's always bad actors in every space, but because alts is becoming more mainstream, there's much more support around the industry. So I think it's important, and I think we'll see this going forward, is those guys who allocated really heavily to real estate, commercial real estate, over the last couple of years, because they were dipping their toe in the water, they are doing the right thing now, which is looking at other asset classes. So it's this diversification within diversification is my number one kind of takeaway, is that someone gets on board with, let's do alternatives. That doesn't mean just doing one part of alts, because as we talked about, some of the legacy portfolios in real estate are going to be a real drag, and there are trillions coming up in refinancing in the next 18 months or so on the real estate side of things, which is a really concerning statistic, because rates are a lot different, and therefore the opportunity, an asset that was profitable previously, now needs to be refinanced. So if everyone had put 20% of their overall portfolio into just one type of alternatives, there might be some issues there. So it's this diversification within, and if we're even talking about private credit, private debt, diversification within diversification within diversification, it's, let's look at this space. Let's pick up some medium, small business loans in this space. Let's look at some secured against real estate, and then let's look at some venture debt as well. So I know that, let's say that we've got a listener who's a 3-man RIA team that runs 100 million or something like that. We get it that you're wearing so many hats already: portfolio manager, business development, client relationship manager. There's a lot going on there, but it is so much easier to actually get access to stuff and to build a small portfolio than 5 years ago, where you need a full-time employee to actually handle the alt side of the business because it was harder to navigate. So the industry now does mean that we can diversify, and it's not a complete black hole as far as bandwidth is concerned like it used to be.
I think you made a great point about the diversification within the diversification, in the sense that if you like a strategy, let's say you like venture debt, and you're like, hey, this is kind of interesting to me. I think it would be a great addition to our portfolio, but I don't know what manager to choose. Well, that's like saying, if you like technology, would you just go buy one tech stock? Would you say, oh, I'm only going to buy Apple, but I'm not going to buy Google? No, you would diversify, right? And you buy a handful. And if you look at who does well, it's typically not funds or RIAs that are betting on like one particular manager. They're basically betting on a strategy and then diversifying within that strategy. So my advice to people is, hey, if you're intrigued by venture debt and you understand the value proposition, don't pull your hair out trying to figure out like who's the best of the 10 good venture debt funds out there. Pick 3 that are different in how they operate within venture debt. I had a potential investor in our fund, is still a potential investor, saying like, I don't know if I should invest in you or Hercules. Hercules is the biggest venture lender in the space. They're publicly traded. They've got like 3 billion plus in assets. Like, we're very different. So I'm like, why don't you go buy Hercules? You can buy their stock on the NASDAQ, right? It's publicly traded, it's liquid, but that also brings with it some risks. Their deals are much different from ours. They're doing like big deals, much larger, 3 to 5 times as big as our deals. They're doing a lot of life science deals, biotech, et cetera, that we don't do. So it's a very different risk spectrum. And they also have a giant existing portfolio that was underwritten over the last 3 years predominantly, whereas we've got a clean portfolio that's really only forward looking. So I would say to somebody like that, look, go buy a public BDC that specializes in venture debt, invest in ARI as an LP, and then find another private fund that's bigger with a longer track record that's kind of like a hybrid of the two. And so now you've got diversification in terms of stage and size, but you also look for venture lenders that have a different industry focus, right? Like, because the risks in early stage life sciences is going to be very different from energy, for instance, or real estate technology. And so I like this idea of diversification. Also want to remind people, like, you don't have to just choose one, right? Like, the whole point is you in fact, not only do you not need to, you should not. You should be diversifying across every strategy that you like. If you like real estate, pick your 3 best real estate managers that have different strategies, right? And so that's a piece of advice that I wish more people would heed. Right?
And it's also there's probably the 2 most common pushbacks that advisors give is, one is liquidity or illiquidity. I wrote an article about why illiquidity is actually a good thing. Happy to share that with anyone. But the second thing is about track record and actually being terrified of new managers. I get it that if you're going to allocate to 4 different people in this space, like you said, pick up a Hercules public company, and then pick a couple of emerging managers or whatever, because I think that's a risk reward play in itself. If people are scared of new managers because of lack of track record, and also they might not have been around long enough for any skeletons to come out the closet. But guess what? A new manager is not going to have a legacy drag on their portfolio. And that is really significant at the moment. So that's a risk reward play in itself. In the diversification within the diversification, make some allocations to smaller, emerging, newer managers, because their performance won't have legacy drag. That's the risk trade-off there, rather than wait 3 years to get a track record, because that's what historically we've done. So that's a diversification play as well. Actually, the age of the manager, especially in this environment where there's so much legacy drag on some.
Those are two tremendously valuable points. And the point about investing in emerging managers is actually backed by a lot of research that shows that emerging managers actually outperform. And most institutional allocators know this. They've read the research, but they still don't do it because there's a little bit more career risk. So they know that they're, on average, they're going to outperform with the emerging managers, but they don't want to don't want to invest in these folks oftentimes, because if they do happen to pick the lemon, then it's going to look bad for them. But that said, emerging managers do, if you look at the data, outperform consistently. And I think a lot of that has to do with incentives and the fact that emerging managers have a lot more skin in the game. If ARI doesn't work out, Zack Ellison is toast, right? If you invest in Hercules and they make a bunch of bad investments, or their stock gets blown up and is down 70% like it was in April 2020, who cares, right? Those guys can leave, like they'll wind up somewhere else. Silicon Valley Bank, half those bankers are gone now. So you had a relationship with SVB, you thought it was going well, they're gone, they're somewhere else. And do you want to interact with the managing general partner of a fund, or do you want to be talking to a 28-year-old VP who's going to be somewhere else, who's just looking for their exit ticket? And that's not true just for venture debt. It's true for every emerging manager. Like, these guys have skin in the game. They're all in. They have to make it work, and the performance reflects that. And one other point I wanted to make about the illiquidity actually being a good thing, I'm guessing it's because it forces investors to not overtrade, and it reduces the behavioral biases that lead them to sell at the lows and buy at the highs. Am I right?
There's a number of points I hit on, but two of the main points are the illiquidity premium, which is even if it's an interval fund or something which has to have a decent amount of liquidity, that probably means that 10 to 20% is sitting in cash because they might have redemptions to meet. That means that the manager like you can't be deploying the full amount into the strategy that earns the damn money, because they have to sit there in cash for the quasi-liquid kind of opportunities. So the illiquidity premium is huge. And if there's two REITs, one private, one public, and all of their characteristics are exactly the same, including their yield, people are going to go for the liquid public one. So the private one has to offer an incentive to tie up your capital for a period of time. And then that other point is the fact that humans are emotional and therefore illogical some of the time. And just think about the beginning of COVID, when so many people pulled out of the market. And I was one of the people who thought we were going to have an absolute disaster, which never actually happened at that point. But then the people who tried to time going back into the market clearly didn't do it well, because that's just how things work. And so if you like something because it makes sense and it's a 5-year play, stick by your guns. If something's illiquid, it means you can't make stupid decisions, because half of the time the stock market peaks and troughs are driven by sentiment, emotion, and it's not a true representation of the actual value. Is if something is valued based on its assets independently by a third party, like a NAV, then that's the true value, not because they missed earnings by 1 cent and suddenly took a 20% hit, which just makes no sense. So it gets us away from that emotional, impulsive investing, which is an issue.
I've got two thoughts on liquidity that I think are relevant. One is that with drawdown funds, like a traditional private credit fund or private equity fund or venture capital fund, the fund only draws down on investor capital when they have an investment to make. So when people say, hey, I want to be in something liquid, my response is, well, you're going to have all the money in your control, so you're 100% liquid until it's invested. And if it's invested in a venture loan, for instance, it's immediately kicking off roughly 15% cash yield. So you're not really as illiquid as you think, because the cash is only being drawn as the fund makes investments, right? So that's the first point. The second is, how much liquidity do you really need in your portfolio? Folks that want to be 100% liquid are giving up yield. They're giving up return. There's a trade-off. There's no free lunch. If you want liquidity, you're getting lower return, full stop. And my thinking is, would you ever sell 100% of your portfolio? If the market was down 30%, would you say, I'm going to take 100% of my investments and I'm going to liquidate them and go stick it in a treasury bill? No. Anybody who does that is a moron, right? And so the reality is you're going to want some of your portfolio to be liquid and a lot of your portfolio to be earning return in that illiquidity premium that you talked about. And what that percentage of liquidity needs to be in your portfolio depends, right, on your individual needs, but it's not 100%, and it's not even close to that. I would venture that it's somewhere for most people in the range of less than 25%, and for institutions as well. And so whenever somebody says, hey, we need to be liquid, I just think, my first thought is this person's naive and has no idea how to run a portfolio. I mean, to be frank.
I often push back to advisors is, with all due respect, if you are doing your job properly and planning long term, you've got to have some illiquid assets in there, because if you need 100% liquidity, either you are in one hell of a unique situation or you've just not done your longer term planning. You are leaving money on the table. And that kind of sometimes gets the message across, because an advisor says, do you know what, you're right, we are leaving money on the table. We need to get together and do a 5-10 year plan, which is in the benefit of everyone at that point as well. So we're on the same page as from that.
You nailed it in the sense that most good advisors rightfully will tell you that you should be thinking long term, right? That's how the best investors think. If you think about like Warren Buffett and the best 100 investors of all time, I bet you 90% of them are long-term oriented investors, right? So if you're investing long-term, meaning 5, 10, 15, 20 year type horizons, then why would you need liquidity? So how can an advisor tell you, hey, you need to plan for the long term. We're going to build you, a 20-year plan and include the next generation in that wealth planning potentially as well. Oh, but by the way, you should be buying liquid investments. Like it literally doesn't make any sense. Like if somebody says both of those statements to you, then you should be thinking, okay, they don't know what they're doing, and I should probably find somebody who does, because it doesn't make any sense. I mean, it's just not logical. So we're just about out of time. I want to just get your parting thoughts on where we're headed the next couple of years and how people should be thinking about that and preparing for it.
So, I mean, I'm going to say a lot of things that I've kind of already touched on is, I think the alt space is the place to be. It's becoming easier. So I think the biggest trend in that is continued simplification, is custodians, billing, reporting, lower minimums. That's a huge thing. Is in one of my presentations, I actually have 2 pie charts which show even 5 years ago, let's say the minimum investment was 250 grand into most quality alternative investments. You need $1 million to even have a 4-way diversification in alts, which probably means your net worth needs to be north of 10 million if you put in $1 million in alternatives. Nowadays, most of the minimums are coming down. And we'd spoken about you actually now having a more of a feeder vehicle to cater for some of these smaller ticket sizes, because we thought that was important. And now, in some cases, you can get quality alternatives for 25 grand a pop, which means 100 grand gets you a 4-piece alternative portfolio, which means your net worth might just be a shade over $1 million. That is huge in terms of, for advisors, the difference between able to service clients with $1 million net worth in the alt space compared to $10 million, where they might only have 2 clients that check that box. So the industry is, the analogy I've used is that the alt space used to be the Amex Centurion card, and now it's the Amex Platinum card. Is you used to have to be ultra high net worth to be able to really build a proper alternative portfolio. Nowadays, you don't need to be. Is when I was at Barclays, I think they called it the mass affluent, which is standard high net worth investors. So the alt space is changing. It's becoming more accessible. The minimums are dropping. The custody is easy with the third-party reports. All of it is making easier for everyone. And I think we're going to see not just a continued growth in the space, but we're going to see continued growth of different types of asset classes, so that things like private credit, private debt, which were not necessarily commonplace, are going to become more commonplace. And it was someone from Apollo recently in an interview said he could see in the near future retail investors having more than 50% alternatives in their portfolio. And I don't disagree with that. I don't think it's that far away because the endowments have had more than 50% allocation to alts for the last 10 years. So that's the way the industry's going. So I think alts are going to become more accessible, easier to invest in, and that's going to be a bigger part of every portfolio going forward.
100%. I mean, that's the big trend. And I think those that get ahead of that are going to see a lot of inflows to their own business because they're going to have access to differentiated strategies, differentiated managers, and they're probably going to have higher risk-adjusted returns as well. And so all of those are going to lead to more asset aggregation for those that can get access to alts.
It's a competitive advantage and it's a competitive disadvantage if people don't have access to some of the more sophisticated strategies, because their competitors will. And clients are getting smart. Clients might have read something on SVB and say to their advisor, what have you got available in the venture debt side of things? And if you don't, that's a problem.
Yeah, I mean, that's what I've been mentioning to people on the RIA side of things. Like, listen, you got to get smart about all these strategies. Whether or not you invest is your prerogative. But if your clients are asking and you don't have an answer, they're going to find somebody who does. So with that, I wanted to thank you for coming on. It's always great talking to you. What's the best way for folks to contact you and find out more about what you're doing?
Richard Hillson, 2 L's in Hillson. You can find me on LinkedIn, or richard@hillsonconsulting.com is the best way to get in touch. And happy to speak to anyone, whether on the investor side, the RIA broker side, or on the sponsor side, in terms of how do we educate, how do we lessen these barriers in the space, because everything is about how we make alternatives easier to navigate and more accessible for everyone, and connect quality product with the end user.
Well, thanks again for coming on, and thanks everybody for listening to the 7 and 7 show with Zack Hillson. See you soon.